active management will continue to be even more important. Certainly, we're not complacent about potential pockets of asset quality risk, and it's clear that some banks' revenue streams will do better than others as interest rates come down. With European financials a key focus, I wanted to share some key learnings. The key thing to know: earnings are still being revised higher for European banks. There's two things supporting that. First is net interest income, which is proving resilient even as interest rate expectations come down. So part of the reason for that is that banks are still seeing low deposit costs, and that's because with ample and comfortable liquidity within the system, there is less incentive to compete aggressively for deposits. The other relevant factor is that banks are also reducing their interest rate sensitivity via hedging activity, i.e. they are not just operating in a vacuum, waiting for rates to come down. The second supportive element is that asset quality also remains benign. There is no real evidence of broad-based deterioration across the sector, and that means that provisioning rates still remain at a low level. Meanwhile, we also had another raft of buybacks being announced by various banks, and that will continue to drive down share counts with the sector still trading at a discount to tangible book value. Now from here, we think active management will continue to be even more important. Certainly, we're not complacent about potential pockets of asset quality risk, and it's clear that some banks' revenue streams will do better than others as interest rates come down. With that in mind, we do still think that the European bank sector is extremely attractive. Despite outperformance over the past 3 years, in valuation terms, the European banks still trade at near relative lows versus the broader market. And that's thanks to those earnings revisions that I mentioned earlier. So from here, we do think that demonstration that earnings and profitability levels can prove to be resilient will support a re-rating from the current lowly levels of less than 7 times PE. And in the meantime, with an all-in yield, including buybacks, of 11%, we are being paid to wait for that re-rating.